So this recent piece from ARK Invest titled ARK's Expected Value for Tesla in 2029, $2,600 per share, implies that in 4.5 years, Tesla shares will appreciate 10 times. So today we want to look at how ARK arrived at that number. It's a lot more complicated than you might think. How Tesla's shares are valued today, and of course the catalysts needed to realize these rich targets. Now, when we look at ARK's simulation outputs, so what you can do is go to GitHub. There's a link from this blog post by ARK, and you can pull up their model and have a good look at it. And it's quite sophisticated. So they use Monte Carlo simulations where they have 45 independent inputs that you can tweak, and these then produce a range of potential outcomes for share price. And then what a Monte Carlo does is it then examines the variations between all 45 of those inputs, choosing random values in a range, and then you can have what looks like this. So here you can see, I think this was somewhere around, let's say, 5,000 simulations, and the simulation with the best parameters is on the furthest right there. You see that big green bar spike to 5,000, the outlier. And then furthest left, you see that little red bar. That's without autonomy, and the worst possible values for the 40 independent variables they used. And you get $350 a share by, let's say, 2029. So when we look at all these different scenarios, they took a look at the ones that thought autonomy would arrive next year, and that was 58%. 38% thought it would arrive in 2026, and so on and so forth. So a very critical component of ARK's valuation is the arrival of autonomy, though that comes in different flavors, and we're going to talk about that. Now, this article by Forbes is rather interesting. It's titled, Tesla Teases a Robotaxi and Other Big Changes. And the gentleman who wrote this describes the evolution of concepts quite well. So initially it was that your car would essentially drive Uber-like services for you when you weren't using it. So people use their cars about 5% of the time. The other 95% of the time, this valuable asset sits there unused. So your car would go out and do things and essentially pay for itself. Then they thought that perhaps they could take vehicles back after their lease was over, take out the controls, and put the car into robotaxi service. Not a bad idea. Then there was the idea, the one we have now, they're going to build a dedicated robotaxi with many custom features not suitable for a private car. So no mirrors, no pedals, no steering wheel. Now, on August 8th, Tesla is supposed to reveal this custom robotaxi vehicle they've been talking about for a few years. Now, that doesn't mean it's going to be generating revenues. They're simply unveiling it. They hinted that the robotaxi and affordable EV are going to be built on the same platform, and that perhaps their affordable EV may be deprioritized. Now, there's just one problem with this whole autonomy thesis. I think people aren't giving enough credit to this potential issue. So here's an article from 2021, and we don't get into politics here at Nanalyze. Everyone's welcome, but it's worth noting, if you're running one of the most valuable companies in the world, and you want to do very transformative things, that there are going to be regulatory hurdles. And this piece, Tesla just got snubbed by President Biden's electric vehicle summit. That was quite surprising to many. Why the world's largest maker of EVs, a United States company, wouldn't be invited to the White House to celebrate ambitious electric vehicle goals. This is purely political. So I think that's going to pose some problems for Tesla. And when we think about regulatory hurdles, well, you're going to need to get permits by state, possibly by city, and Musk is probably going to look to places, states, let's say, where he enjoys, well, we'll call it political popularity, high population areas where Cruise and Waymo are not at. And he'll likely take the same path that they do. So when we look at progress being made, we see they've renamed full self-driving to supervised full self-driving. That's interesting, perhaps to fly under the radar of regulators. And then Tesla owners are getting this free 1-month trial of the current product, then $100 a month instead of $2. So perhaps Tesla's overestimating what people are willing to pay for this sort of functionality. But what's interesting to note more recently is this notion of human ride-hailing that's going to be supposedly coming soon. Human Ride Hail Musk describes this as a mashup between Airbnb and Uber. So your car essentially becomes hailable. So perhaps you can designate a segment of people who can hail it, maybe family members, or anyone can hail it that has 5 stars, perhaps, right? And what's interesting to think about is if the car doesn't have passengers. So let's say my brother wants to borrow my car and I tell my car it's okay and it drives itself over to my brother's and now he's driving it for the weekend. What are regulations going to look like for an autonomous vehicle without any humans in it? Certainly different from one I would think. It would have to be easier in that respect. So that's something to think about. Now, the bulls and bears, this is all about autonomy. So the bulls are going to argue that autonomy, and ARK as an example, will provide 90% of Tesla's value in the future. So it's not just a car company. What are the bears going to say? Well, we've been hearing this for years. It's a car company. So always use the Chinese menu approach to bulls and bears, one from column A and one from column B. And what we see out there is a very divisive community. So pundits who decide to fuel that are just demonstrating their immaturity. The reality is that there's things to take from both sides. Now, we're all trying to do the same thing here, which is to generate alpha. Now, speaking of which, I would welcome you to sign up to our weekly newsletter. This is one of the mechanisms we use to help people become better investors. We don't sell our products very heavily on this channel because we believe that if we help you become a better investor, then you're going to open your wallet and support us down the road. So we'll put a link to that in the description of this video. Make sure to sign up. There's an article we have coming out. It will be out by the time this video is published, which talks about the robotaxi thesis in a much broader aspect, Tesla just being one component of that. So let's talk about valuing Tesla. Well, what does Tesla do right now? Well, 81% of revenues come from electric vehicles, 8% come from energy storage, 11% other. So what does Tesla want to do? Well, we talked about hybrid ride hailing, the robotaxi concept, humanoids. Each of these ventures you're going to have to value differently, and there's all sorts of aspects, energy storage, insurance, the lithium bits, and you can see here this is taken from their most recent quarterly deck that looks at that stuff. Now, this chart from ARK demonstrates very well how ARK is coming up with such a high valuation for Tesla. You can see here revenue by business line down the road. They're expecting 63% of revenues to come from robotaxi, but that's not where the high valuation comes from. It comes from 86% of their earnings coming from a business line that hasn't even started yet. So that's easy to understand the aggressive share price targets. Now, a quick note about ARK. We did this piece recently, Kathy won. I was shocked how many individuals wanted to bring religion and politics into it. Now, I worked as a hiring manager at a top financial firm for over a decade, and I can't recall a single case where we gave a flying fuck about what you believed in or what sort of a political stance that you took. So these are the sorts of people that leave the aged well comments. So they're lazy both ways. 90% will be this aged well, sarcastically referring to something they think didn't age well, whatever that even means. What we need to look at is what worked and didn't work. So whenever we publish something and cheerleaders come around deriding it, we'll say, well, what facts did you disagree with? And after something has sufficiently, quote unquote, aged, well, how were the facts interpreted incorrectly? What was missed or not considered? So if you want to attack ARK's price targets, attack their model so we can all learn something. Now, when we look at their model, it's very sophisticated. I'd like to see all these critics of ARK, half of them even be able to navigate their way around this spreadsheet. It's very impressive. And you can see that what they've defined here is key drivers along the top. They mention Wright's Law. They actually have an entire blog post about this. I was unaware that of their idea here that Moore's Law should be replaced by Wright's Law, which states that for every cumulative doubling of units produced, costs will fall by a constant percentage. Quite interesting. And they look at that, how that can be applied to various investment theses. So when we look here at key drivers, you can change these 5 variables and 35 other variables you can see running down the page here. But when we scroll down to this model, so anything that's in black text is fixed and you can't edit it. Of course, these are the results of your inputs produce these numbers. And here they have enterprise value for every component of the business. They've taken into account insurance, EVs, robotaxi, human-driven ride hail, and stationary energy storage. Now, one thing to note here, we keep things very simple. So enterprise value, as you can see here, isn't far off from market cap. So let's just pretend these are market caps, right? That's very easy for everybody to understand. Now you can divide these values, enterprise value or market cap, by earnings, and you get another value, a ratio. That isn't very different from calculating price to earnings ratios, all right? So further down the sheet, you can find where they let you define what you think a fair valuation is for the different components of the business. In this case, EV divided by EBITDA. Let's just say market cap divided by earnings, okay? So the idea here is that you're going to have to value different components of the business differently. And because Tesla today is an electric vehicle company, and we understand that automotive makers don't enjoy very high valuations, that's what the bears are saying. It shouldn't be valued as high. And the bulls are saying, well, that's coming down the road and need to value it much higher, right? Now, what's cool here is you can take those key drivers, and we just put in 0% cars sold into the human-driven ride-hail network and in 2027, and then robotaxis launching in 2028, so outside the model. And look, it appropriately zeroes out enterprise value for robotaxi and enterprise value for human-driven ride-hail. So feel free to open up this model and take a look, and they've documented the hell out of it, and look at their assumptions and challenge those assumptions and say, I think this variable is quite aggressive, right? Really give this a sufficient looking through before criticizing their price targets, right? Now, when we look at valuing Tesla outside of that elaborate valuation model that ARK's provided to the public, there's several approaches we can take. There's, of course, price to earnings ratio, a forward-looking PE ratio, right, looking at where they might be next year. And there's price to sales, what we call simple valuation ratio. But today I wanted to focus on price to earnings. So what we can do to get a benchmark is go to the MSCI World Automobiles Index, all right? And you can see the first problem we run into here is that Tesla's 45% of this index. So they're certainly driving that average up a lot. So when you see here, it's down there towards the bottom, the MSCI World Automobiles has an average PE of 11, whilst MSCI World, so all the companies in developed markets, that has an average of about, 22. So automobiles enjoy typically very cheap valuations, much cheaper if we took Tesla out of the mix. Now, calculating PE, you shouldn't throw the number around unless you can calculate. It's very simple. This was taken, I think, from Macro Trends and shows Tesla's PE over time. You see their current PE is 62.85. Well, is that high or low? Well, it's high relative to MSCI World at 20, or relative to automobiles at 11, or relative to NASDAQ at 30. So it's quite high. So when we look at Tesla's earnings per share over time, we see that it's quite variable. Only recently did it become positive, where a PE ratio would actually work, and now we can start to use that. It's mature enough, but you see the trailing 12 months there, it's coming down, so it's trending downwards, and also happens to be very volatile, which is reflected in the share price. Now, what we can then do is look forward, and here we've taken the high estimates of earnings per share next year, 541. If we use that and take a forward PE, it's still around 45. We'll compare that to NASDAQ's average of 30. If you took NVIDIA's PE, the last time we did this exercise, forward-looking PE, based on the median of analyst estimates, they actually came in at average of NASDAQ. Really cool, right? Because that's what it should be. The average forward-looking estimate ought to reflect the average of PE. Now, you could say, well, it should be richer. Well, when you look at the range that the analysts gave, you can take that either way, right? Depending on what you forecast the company will do in terms of earnings per share. Now, one thing to note here that's very important: when does Tesla become a humanoid company? When they start to segment that revenue out. When do they become a robotaxi company? When they add that revenue segment. Here you can see segmentation. This was the first time that they broke out energy generation and storage as a component, along with services and other revenue. I've put the combined percentage of those two segments along the top, so you can see once it's above 10% consistently, that seems like about when they'll add it, all right? So what will happen is that these events are going to create a lot of volatility in valuation models. And of course, as you can see today, volatility brings out all the wankers, and their double hump and pump formations were right. And then they successfully predicted the price of Tesla. And, technical analysis, we see a lot of that lately. It's really astrology for men, right? If it was that easy to generate alpha, everybody would be doing it. So the I'm all in on company X people, we see a lot of those out there, especially whenever a share price is going up. They don't seem to know much about company-specific risk. Anything can happen. Just think of what would happen if Musk ended up in the hospital, right? So these are things you need to consider. Now, we also need to consider competition. Musk says China rivals work hardest and smartest. He's absolutely right. We've written extensively about Chinese EVs. I spent time over there meeting with some of these companies and evaluating what's going on. And the Chinese have an inclination to copy, but it's kind of smart. Why reinvent the wheel, right? So that strategy seems to have worked out quite well. Musk sees the toughest competition for Tesla is in China, and here you can see just how much the Chinese have blown up. So I think it's worth evaluating the giant panda in the room and the dependencies that Musk has going back to that company-specific risk, right? The dependencies Tesla has on China. We've covered that in this video, so give that a watch next. Please make sure to subscribe to our newsletter in the comments section. Thanks so much for taking the time to watch this today.